The S&P 500 closing at a record high along with the NASDAQ on Tuesday. Joining us now to talk markets, Alicia Levine, Head of Investment Strategy and Equities at BNY Wealth. Any angst, nervousness, trepidation, cautious optimism, anything that you would tell investors to be wary of or just full steam ahead?
So, as I like to say, as a strategist, our job is to worry, but we have to invest our client capital every day. And so we are constructive on markets. We are positive. We think the fundamentals are strong and in certain sectors getting better, raising the earnings for the S&P overall. So there are some charts that are asymptotic and that looks not healthy. But on the other hand, the fundamentals are increasing as well.
So if you totally took AI out of the picture, there are still other fundamentals that are positive for equities.
Right.
And then you add in AI and you get what we're witnessing.
You have the next leg of innovation in the economy reflected in the companies in the S&P. So it's hard to get negative on a fundamental basis with what's going on in the market. So we're just very optimistic. We're overweight U.S. large cap. We've been that way for the last 2 years. Again, it's just been the right place to be because in the end, other countries are looking better than feared, but the growth here is so much stronger in the developed economies that you have to be invested here, we think.
Typically, when there's these transformative technologies and change, you've heard in the past, you put a .com on the end of a company and it's going to go here. Or with biotech, I forget, it was a monoclonal, anything that would indicate that you were involved in this hot new technology. And the stocks would always overshoot where they should actually be. There's none of that in AI right now?
There may be, and if you remember from the late 90s, that the initial winners weren't necessarily the ones coming out in the mid 2000s of who actually won the horse race there. So innovation is always changing, but I'd say this, the hyperscalers are so big and the companies are so big and throwing off so much cash flow that in some ways there are moats around them, and there are moats with alligators. It's just very hard to be competitive, and in the end, you see, for instance, that if there are competitors, there are then partnerships. So in a way, the large cap companies are able to take in some of the innovation of other companies and thus not be threatened by it.
If we were going to have a recession, would that cause you to lighten up on your equity exposure?
Yes. Okay. So recessions are always associated with earnings downgrades, and in the end, we're looking at earnings, cash flow, and margins. That's what we care about. So a recession would affect that, and yes, we would. So
then you have to have confidence that the Fed has orchestrated a soft landing because they're trying. Inflation looks like it's coming down. Right. On the flip side, what you worry about is they might overshoot and slow the economy down too much. You don't think that's so? They usually aren't able to walk that line. This time they're going to be able to do it.
It looks like they're able to do it.
Amazing.
It looks like they're able to do it. I think the resilience of the U.S. economy in the face of the onslaught of the fastest tightening cycle in 40 years tells you there's a lot of resilience in the households. I mean, households' net worth is up 40% in 4 years. It's $40 trillion, $45 trillion. And so in the end, there's a lot of resilience there within the economy in the aggregate, even though it's obvious that there's some parts of the economy, lower and workers with lower wages are struggling because they're spending on credit, and credit's expensive. So if a company or an individual or a household has to borrow on the short end, that's where the pain is.
Where did the rest of that come from? The stock market or housing prices?
Housing prices overall are up about 40%, more in some markets. Some markets are up 100%. And ultimately, the flip side of not having corporate pensions anymore or not having sufficient pensions from the government is that individuals are responsible for investing for their retirement. And as a result, households here in America are just more exposed to the stock market. So the wealth effect is just spread out much more across the economy here than it is, for instance, in Europe.
So you mean no more defined benefit, defined contribution?
Everybody's paying attention to the stock market, so they see it. So in a bull market like this, where fundamentals are good, people feel confident and they spend. It's not that there aren't signs of worry, because there are. We see it in some of the consumer stocks in the consumer sector. Some of the data have come in softer. The market itself, the bond market's pricing in a cut in September. It may happen. It just seems that the resilience of what came before this, which was 15 years of zero rates, essentially made the greater percentage of the economy immune to the higher rate cycle.
So people are buying NVIDIA today. They're buying it with a $3.3 trillion market cap. Where do they think it's going? Is it going to $4 trillion?
So I can't talk about individual stocks,
but
I would say that the growth rates of the stocks that have done well are commensurate with the increase in the multiple and where the stocks are going. The growth rate are higher as well. We just put out actually our new forecast for the S&P for the end of the year. We're at 5,700 for this year. That implies a 12% growth rate this year and next year, driven by increased earnings in communication services and in information technology.
Yes.
So yes.
It's just, it's
staggering.
Yeah, it is. It's staggering.
It's staggering, but the earnings and the cash flow are there. And if you look over time, the cash flow increase is associated with higher margins and higher multiple over time. So when we talk about the multiple's now about 20.5 times. It's not unreasonable given where free cash flow is overall in the S&P, driven by the top 10 stocks.
I know it's not unreasonable, and I know that this is not the dot-com bubble again, but sometimes the market isn't rational, to the downside or the upside. There could be a time where people say we don't believe it, or a time where big corporations pull in and aren't willing to spend as much, because it has been the big companies that are spending the money that's so necessary on this. Longer term, long haul, sure, maybe it's the right direction, but that doesn't mean you can't have a pretty significant pullback from time to time.
You can definitely have pullbacks. I think on the fundamental side, the fundamentals take us for the next 18 to 24 months. Mm-hmm. The big risks, of course, are the ones that are not priced in. So what's not priced in? Recession's not priced in. Inflation rebounding is not priced in. And, of course, any exogenous shock is not priced in. And we all talk about the deficit. Yeah. Last week, CBO told us $2 trillion this year again. Yeah. So that's the risk. It's funding it in the bond market.
It's not the deficit. This fiscal year is 7% of GDP. Never been like that. And by just where we are right now, it's going to be 122%. The debt held by the public, 122% by 2034. It's going to go up every year. It was never over 100 before that. Does he believe in MMT?
Do I believe in MMT?
Yeah.
I do not. I do not. But the two candidates running for president have no interest in reining in the debt rate or the deficit rate.
Or entitlements.
Or entitlements.